your approach is different from some others, because if in other cases, people will take a look at that data and they'll say somebody's not performing well on these characteristics, let's kick them out of the portfolio and invest in somebody else. And what you're saying is actually the sound thing to do is to stay invested in that company and work to improve their performance.
Well,
and
the way we might put that is we might not be invested today in that company, but we want to engage with them to see whether they're prepared to take the steps to improve. And when we see that momentum, that's when the allocation of capital fits our values, fits the values of our clients, and most likely could enhance returns. And it's that engagement. Are you prepared to take on board the next steps on that journey? And if you are, well, we're going to help you along the way. About 7 or 8 years ago, one of New Zealand's largest companies, now A2 Milk, really wasn't going along on this journey at all. They didn't have any measure of their carbon footprint as an example. Why can't you start moving along that journey and actually go further? Why can't you back it through into farm sustainability and assist the whole supply chain? And it doesn't have to be done overnight, but we want to see momentum in board decisions by management, and decisions by suppliers to move along that pipe. George did a huge amount of work last year on, I'll take, for example, carbon emissions, survey of the NZX, and you might like to ask, and the huge variety of approaches. We know 4 or 5 companies really are doing incredibly well in this regard. 10, 15 companies have started the journey and a lot more to do. And then the balance, a bit disappointing to be truthful.
The record of large New Zealand companies reporting on climate emissions has been pretty patchy, to be generous. And are companies really stepping up to this, or are you having to try and drag them kicking and screaming into it?
Well, I think that policy development has a lot to play in this space. So we're seeing, for example, in New Zealand, the government's introducing, well, they started a market consultation into mandatory climate change disclosure. So I think the awareness for corporates is starting to grow, and they're starting to see the need to start disclosing their emissions. Investors like us also have a part to play, and we've also been sort of advocating increased disclosure over time. So I don't think corporates really have an excuse to ignore it anymore. And as investors as well, we'd also like to be able to carbon footprint our portfolios. And that's just not something we'd be able to do unless companies are actually measuring and reporting their emissions. Like Fletcher Building, for example, have looked at science-based targets, which is a sort of scientific verified way that publicly holds them accountable. And a range of other companies have set, targets for 2030, 30% reductions in their scope 1 or scope 2. I think they're all trying to head towards that same goal of getting to net zero by 2050. And I would just add that divestment doesn't really create any change in the marketplace. You're basically just selling your shares to someone else and making it someone else's problem. But creating the change necessitates you have stake in the company, and you're able to engage and leverage that active ownership that you do have. The market now has grown to roughly $200 billion in responsibly invested assets in New Zealand, and that's grown significantly over the past few years.
It's interesting. So in addition to that survey by the Responsible Investment Association, we do a joint annual survey of the New Zealand public. And that's really interesting because it shows a big appetite amongst the public, which is not currently being met. And one of the reasons for establishing Mindful Money is because people until now haven't really had access to the objective information and the transparency about portfolios and so on. So that very much what we see our role as being in growing the market. you think there are some sectors, and she says, you know, maybe oil or downstream petroleum or coal mining, where actually divestment might be the right thing to do rather than engagement?
My perspective is yes, that's correct. There are some sectors that you want companies to exit. Often, the large conglomerates have other aspects to their business. So here's the tricky question. It might be fine to exit a particular thermal coal operator, tick. But what if that thermal coal mine and all the infrastructure is sitting within a larger conglomerate that has plans to change entirely their electricity production to renewables? And one of Europe's largest emitters is actually now Europe's largest renewable energy company. And in New Zealand, you know, we have probably two companies that, you know, are really tricky investments because of the thermal coal they use, really tricky, and a very high hurdle for many investors to invest in them. And in fact, as of today, we aren't an investor in either of those companies, potentially for other reasons. But you could see that the solution for New Zealand to decarbonise has to involve both those companies. They have to get capital. They have to change what they're doing. So just to divest may not always be the answer. May not always. But I think if we're just talking about a pure new mine, a pure coal mine, I can't personally see the rationale for those being included in portfolios.